We know the pitch. Buy a hot stock tip, go to sleep, and wake up rich. But when market volatility hits, fragile positions just shatter. Sustainable mid-term swing trading requires a system designed to mathematically absorb losses rather than attempting to avoid them entirely. This chart displays actual performance. We capture solid gains, like 26% on an auto stock and 16% on consumer goods, while taking calculated hits of 10% and 12% in hotel and gas positions. Aggregated, they balance into a stable 5% net growth. The trade-off here is pure patience. You have to trade the adrenaline rush of gambling for the discipline of sitting through long, boring weeks where your positions just drift sideways. Professionals survive those boring stretches using a framework we call risk-to-reward architecture. Professional capital protection relies on mathematical engineering, structuring trades so that your downside is strictly capped while your upside remains asymmetric. Let's look at the first analytical framework, the support bounce. This is a defensive setup built explicitly to preserve your capital. Take Motherson Sumi Wiring as a case study. It recently hit a multi-year floor and is currently trading right around 40 rupees. This matrix lays out the math. You enter at 40, place a stop loss underneath at 36, and target 50. Visualized, your exposure is a tiny 4-point risk box. If it works, you capture a 10-point reward, a 1 to 2.5 ratio. The cost of keeping your risk box that tight is vulnerability. A brief intraday flash crash can easily clip your 36 stop loss and shake you out of the trade before it actually moves higher. If you prefer aggression over defense, the inverse strategy is the resistance breakout, designed to capture upward momentum. Look at BL Cashiap. It is hammering against a stubborn resistance ceiling around 59 to 60 for the 6th consecutive time. Returning to our matrix, if that ceiling finally shatters, historical momentum suggests an aggressive upward trajectory targeting the 75 to 85 zone, but buying before the ceiling actually breaks is dangerous. If that 6th attempt fails and rejects off the high, your capital is exposed to a steep, sudden drop. Selecting between a support bounce and a breakout dictates whether you prioritize an unshakable baseline or maximum upward velocity. The round bottom is a structural setup designed for capturing massive, macro-level market trends. Take NewGen Software as a perfect example. Forming the base of this pattern requires the stock to endure an extensive, multi-month consolidation phase. This animated vector line maps the process. Notice the timeline on the x-axis. Your money sits in a horizontal dead zone for 6 to 8 months before the line finally curves into a profitable upward trend. If the pattern completes, this setup positions your portfolio for outsized percentage gains across a 6 to 12-month horizon. The catch is the severe opportunity cost. Capital deployed into a round bottom is effectively locked. While you wait half a year for the curve to resolve, that money is unavailable for faster, short-term market opportunities. Executing a round bottom strategy requires trading your portfolio's liquidity and your own time for a higher probability of macro-level success. Next, we move to the most structurally defined setup in this system, the channel continuation. In the case of BLS e-services, the stock is consistently ping-ponging between parallel support and resistance lines. To time a purchase within that moving channel, traders rely on a specific micro-entry trigger called an inside bar. Here is how that looks. A large price block completely engulfs a smaller secondary block. When the price breaks upward from that smaller block, it signals the trend is ready to continue. Trading within channels provides crystal clear invalidation levels. If the price ever drops below that bottom support line, your entire trading thesis is instantly void. Unlike the set-and-forget nature of long-term investing, navigating a moving channel demands vigilant, weekly chart monitoring. Channel trading requires you to sacrifice personal time and attention in exchange for extreme precision in your risk management. Building a profitable portfolio requires the deliberate selection of architectural setups that match your personal time constraints and risk tolerance. To make that choice, we can map these strategies onto a final evaluation framework. This quadrant chart plots 2 non-negotiable variables: the active monitoring effort required on the y-axis against the time your capital is locked into the trade on the x-axis. The Motherson Sumi support bounce drops into the low-risk, short-term quadrant. It is engineered for risk-averse beginners who want tight, defined stops. The new Gen round bottom lands in the low-monitoring, long-term quadrant. It requires months of patience, making it ideal for time-constrained optimizers. And the BLS e-services channel requires high monitoring over a midterm horizon. You must actively engage with these charts every single week. Adopting a trading setup that mathematically contradicts your daily availability or your psychological capacity for loss will inevitably lead to failure. A truly robust trading system occurs when every individual setup functions harmoniously inside your strict personal risk boundaries. True profitability is only achieved when the mathematical logic of the trade perfectly aligns with the personal constraints of the trader.